Nathan here. It's official, mortgage holders are feeling the pinch with 7 rate rises in the last 7 months. Banks are taxing loyal customers an average of 0.5% more than new customers. In this video, we're going to go through how you can renegotiate with your lender to get a better rate, including one tip to get the rate down today and a step-by-step process on doing that. If you're a mortgage holder or thinking of buying a home, then this video is for you. If you're new here, be sure to smash that subscribe button because we talk about all things property and finance. Let's kick things off and talk about why some home loan rates are lower than others.
Banks base their interest rates on the amount of risk per customer. But if you have a lower deposit, generally you're going to be paying a higher interest rate than compared to people who have a bigger deposit, might have a 20, 30, 40% deposit, because in the eyes of the bank, they're seen as lower risk. So it's pretty common as a first home buyer or a home buyer in general, you might buy your home with only a 5 or 10% deposit to get into the market. And this is a great way of getting into the market. Over years, you might build up equity, pay off your loan, your property value increases, and you become a less risky borrower and potentially eligible for better interest rate. It's the same case if your property is an investment. The banks have a whole different set of rules based on interest rate, and different banks have different offers. Overall, what this means is you could potentially be eligible for a lower rate today and not even know about it. As Nathan mentioned before, what we're seeing in the mortgage market at the moment is something called the loyalty tax. Banks are offering new customers better and better deals to get them on the books, to get them on board, to join up and sign up and say, hey, here's a shiny new mortgage you can join. And they kind of assume as an old customer, you just leave your loan there and don't bother about reviewing it. In fact, I had a catch up with Andrew and Sharon yesterday, and we had that same situation. They'd been with their bank for over 7 years. They've been happily paying it off, thinking that everything was going well. And they'd only just started to notice in the last few months, their repayments have been creeping up and up and up. When we sort of got down to brass tacks and looked at the numbers, their interest rate was over 5.5%. We managed to look at another bank who were offering interest rate 1% lower. Now, that sounds like all numbers on paper, but what it practically meant is that if they kept making the same repayments they're making today on their higher 5.5% interest rate, and we got down to 4.5%, they'd actually end up paying off their loan 5 years quicker. It's insane. By that change in interest rate, that 1%, it means that they're going to be debt-free 5 years faster than if they just left it and kept with the current lender.
How do banks mess with your interest rate?
The biggest mistake that's catching out a lot of home buyers at the moment is when their fixed rate ends. Over the last couple of years, there's been some crazy cheap fixed rates, and they're coming up to expiry. What the banks can do is they don't give you a very good discount when it comes off the fixed rate. I had someone the other day who had a fixed rate at the Westpac. They were happy as it was at 1.99%. Next month, it reverts back to the bank's standard variable rate, which is over 7%. If they hadn't contacted us, they would have gone back to paying 7%. Their repayments would have gone an insane level, and they'd be stuck paying that higher interest rate. Fortunately, we were able to renegotiate with the bank and look at a better discount for when it went back to variable. That's the first way. The second way that the banks can mess with your interest rate is when the Reserve Bank meet. They can, instead of passing on what the Reserve Bank has increased the rates by, for example, by 0.5% or 0.5%, they can add on a little bit. You might think, oh, the Reserve Bank's only done 0.5%, that bank's done this, that's fine. Your bank can end up passing on 1% and increasing your interest rate more than you realize. The third way we're seeing banks mess with their interest rates at the moment is offering bigger discounts to new customers rather than old ones. It's a pretty common one. When I got my first home loan over 10 years ago, at the time, the banks were giving a 0.7% discount off the standard variable rate. And that seemed like a huge deal for me at the time. Fast forward to today, banks are offering 2.5%, 3% discounts off the standard variable rates to new customers. If I just kept my loan ticking along how it was over the last 10 years, I'd only be getting that 0.7% discount and missing out on 2% of extra discounts and taking longer to pay off my loan.
What happens if you have your loan, you've had it there for a few years, and you want to know what the lowest possible rate you can get is?
Yeah, the first thing you can do is contact a mortgage broker like us, and we can help you through that process. We've got software and systems that'll help find that pretty quickly. The second thing you can do is have a look on your bank's website. They'll often advertise some of the better interest rates available to their new customers on the home loan interest rate page. And you can use this to work out, well, how far off is your current interest rate to what they're offering new customers. The third thing you can do, which is a bit sneaky, I've seen people do it and it's worked a treat, is call up your existing bank, pretend to be a new customer, say, hey, Mr. Bank, I'm thinking about getting out a home loan. I'm looking at getting, refinancing a $500,000 home loan. What rate would you give customers? They'll tell you. You can use that information then to call them back, speak to the retention team and say, hey, I've been with you guys for 5 years. I'm paying 6%. I was told you're giving new customers rates at 4.5%. What is the go? Let's work something out here. By doing this exercise, you're going to find out what are the better rates that your current bank's offering, and if you're going to be eligible to move your current home loan to that better product.
What will stop the banks from negotiating with you?
A few things that will stop the bank from negotiating or renegotiating your current home loan will be if you're fixed. Some banks will currently say, like, sorry, you're currently fixed. Until that finishes up, we're not going to look at reviewing your current home loan. Keep that in mind. The second thing is if your property value has changed since you bought the home, some banks will look at what the original value was. We had a client that bought their home with the bank 5 years ago. They'd done a bunch of work, they'd done renovations, and the property value had increased from $300,000 to $800,000. It was huge. Unfortunately, the bank said, well, on file, it says the house is only worth $300,000. We're going to base off that. And their loan, they're still at 80%. We're not going to give you a better rate. Fortunately, we're able to go to a new bank. Keep that in mind. If your property value has changed a lot, sometimes the banks may want a new valuation to reconsider renegotiating. The third thing that'll stop you from renegotiating with your bank is your products. If you're not fixed, if you're on a variable rate, there are some products that the banks won't change your discounts. If you have what's called a basic home loan, it might have redraw. It has no annual fees. Some banks don't actually have the ability to change the discount margin, how much they're taking off the rate in the background. They might be offering new to bank customers discounts of 2.5%. You might be still on that 0.7% and missing out. And the bank's just going to say, no, bingo, sorry, we can't actually give you a better discount. Maybe you need to look at changing products. The fourth reason banks won't potentially renegotiate with you if you've had a change in circumstances, if you've missed repayments on your current loan, if you've had defaults, if you've got any history on there, they can see it on the system. And sometimes they'll just say, no, sorry, no further discounts. It might be time to look at other bank options.
And how do you maximize your home loan discount?
It's getting a couple of different bank valuations. We've seen a huge range in bank values. I had a client that had a property in Mackay yesterday. We're doing a valuation on their property. One bank valued at $380,000, a second bank valued at $400,000, and the third bank valued at $465,000. It's a $75,000 difference across three banks in one day. Keep in mind that different banks have different valuers, they have different methodologies of valuations. And really, to my point earlier, the lower risk you are, the lower your loan is compared to the property value, the better rates you're going to have. The second way to maximize your discount is to think about the loan purpose. Generally speaking, the banks will give you a better discount if it's your home that you're living in, owner-occupied home, compared to an investment property. Did you know there's actually some banks that will give you the same discount, owner-occupied, with an investment property if you have both properties with the one bank? There's a couple of ways to maximize this. A good broker can help you through this. And the third thing is the type of repayment. You might have interest-only repayments. The banks will generally give you a better discount if it's on principal and interest. Keep that in mind. Obviously, you need to look at your cash flow and see if it makes sense in that new structure.
How do you haggle with your bank?
Let's break this up into new borrowers and existing borrowers. If you're a new borrower, your mortgage broker should be able to help you through this process. They'll know what some of the better discounts are at different banks and different institutions. And we can actually use this. We can say, hey, Nathan, I'm speaking with Macquarie Bank, ANZ, et cetera, et cetera. I'm looking at a new bank with St. George, for example. Can you guys match this or beat this? And sometimes they'll come to the party. They'll look to retain you and say, yep, as a new customer, that's fine. We'll give you that. They call us a pricing request. And banks actually have individuals and teams reviewing these individual pricing requests and saying, yep, I want Nathan as a customer. He has a great deposit, good income, and we want him on the books. If you're an existing customer, there's two ways of going about this. The first way is speak with your mortgage broker. They can go through the same process, go through the pricing team, put in a request and say, hey, Mr. Bank, I'm going to leave. What can you do? Oftentimes they'll come to the party and offer you a bit of a better discount. The second way is you can call up the bank yourself as a customer and say, hey, bank, I've followed through the steps before. I've looked on your website. I've seen this better rate online. What can you do? I'm going to leave. See you later. And oftentimes, more often than not, they're going to say, hey, don't leave. Here's a better discount. The third thing you can do, which does work with some banks, and we've had some pretty good success this year with people doing this, is actually filling out the discharge request, is saying, see you later. I'm out of here, guys. Here's the form. I'm going to another bank. I had a customer earlier in the year that did this with one of the major banks, filled out the discharge form, had actually gotten approval from somewhere else, said, yep, I'm leaving. See you guys later. I'm out of here. The bank called him immediately and said, stop, Jaden. I don't want you to leave. I'm going to offer you $2,000 to stay and a better discount. It's interesting to see how some banks can be completely reactive. It makes no sense. They'll do this to retain your business. Again, like I said, speaking with a good mortgage broker like Nathan and I can help you through this process and work out what's going to work best in your situation. There's potentially new banks that are offering $3,000, $4,000 to switch banks. In some cases, it can make sense to move altogether.
When does it make sense to refinance? Because loyalty isn't what it used to be.
It used to be the case where if you had your main bank account, if you'd always been, a CBA Dolomite customer, you'd have all your banks, your credit cards, everything there. The banks would be like, yep, I want you to stay. I'm going to offer you better discounts. I'm going to give you some insurance and some different things to stay with that bank. Fast forward to today, banks aren't sort of seeing that as much. They've got algorithms that are looking in the background and saying, well, if Jaden seems like the kind of customer that's going to bounce around and change banks every 6 months, we actually don't want him, letting him leave, and we're not even going to try. Banks aren't really looking at the fact that you might have had an account with them for 10, 15, 20 years. They're not looking at the fact that you've got all this money sitting in your offset account, you've used their savings account. They unfortunately don't care. It becomes a bit of an algorithm and it's a situation of the computer saying yes or no. It's worth speaking with the broker to see what options are there. Are there digital banks or online banks that offer better options? Are there any other competing banks that are just looking to grow grow their business and offer you a better interest rate? Are there better products? You might be able to change from paying an annual fee to something that has a lower monthly fee or no fee at all. That's going to work better in your situation. If you're gearing up for it to be an investment property, does an offset make sense? A mortgage broker like us can help out with that and see what's going to work in your situation, what your plans are over the next 2, 3, 4, 5 years, if a fixed rate makes sense, and all these things should get factored in before you look at refinancing and moving bank. Keep in mind is if you do refinance, you can actually keep the loan term the same. If you've had your property for 3 years, you had an original 30-year loan term, there's sort of 27 years left. When you refinance, you can keep it at 27 years. There's no need to reset it and pay more interest than you have to. We can work through that to make sense. If it's going to become an investment property, like I said, there's lots of different variables there.
Which banks have the lowest interest rate?
Lowest interest rates can be a bit of a misnomer because, as we've seen from previous rate rising cycles, just because the Reserve Bank increases by a certain amount doesn't mean all the banks will follow. 7 rate rises in, all the banks have copied what has happened with the Reserve Bank. When the Reserve Bank's done 0.5%, they've done the same. I think mostly because of competition. Previously, in 2008, 2009, we saw the banks adding extra on, and they all did different amounts. So, Westpac might have done an extra 0.1%, Combank might have done 0.12%, ANZ might have done 0.5%. Like it was all different. That's not the exact figures. You get the idea that all the banks don't have to move uniformly when the rates are going up. You need to have a broker that's going to help you with this. You need to factor in things like what the fees are going to be, what the rebates are going to cost. And if you've got a $250,000 loan, you're getting $4,000 cash back, then it could still work if the interest rate's a little bit higher than something lower. You need the broker to sort of model this out for you and to see what's going to make sense in your situation.